Hello accounting students, and congratulations, you have reached the next to last module of the class. And now we're going to get a little bit sophisticated and very focused on the real world, because we'll be entering the world of home mortgage loans, and really any other kind of loan where you're borrowing a certain amount and you're agreeing to pay a flat payment per period, meaning with every year that goes by or every month that goes by, whatever you've agreed to pay it over, every time you make a payment, the payment is the same dollar amount. Now let's take a look at figure 13.7. That is 13.7. You've borrowed $10,000, and I guess this must be one of those tiny homes if you only need to borrow $10,000 to buy it. And since the mortgage is so small, you've agreed to pay it off over 5 years. Your annual payment, however, is the same dollar amount each year. It is precisely $2,773.93. Now, by the way, it's about the payment, it's about $1 more in the fifth and final year, but the textbook explicitly says that's a rounding difference, rounding error. So for all intents and purposes, you're paying $2,773, the same amount every year, every period. Now, how do you figure out how much of each payment is interest and maybe even deductible on your income taxes as interest expense, and how much goes towards paying down the principal? Well, let's look at year one. In row one, you begin with a $10,000 debt. Your payment every year is $2,773. Because the interest rate that you're paying is 12%, you say, this year, my total interest payment is 12% of $10,000. Well, that's in total $1,200 of interest. Well, if you're paying $2,773 in total, and if $1,200 of those dollars is interest, then the remainder of the payment, that is $2,773 minus $1,200, or $1,573, is paying down the original principal or the original amount of the loan. How much do we owe this year? Oh yes, $10,000. So if we began the year owing $10,000, and if out of our total payment, $1,573 is being used to pay down the amount that we owe, then the amount that we owe at the end of the year, the ending balance, is $10,000 minus $1,573, or $8,426. Well now, if we owe $8,426 and 7 cents, I should say, at the end of year one, well then you wake up on January 1st and you start year two with the same beginning balance. You owe $8,426. What's your payment in year 2? Well, the payment never changes. It's $2,773. How much of that payment is interest? Well, you're always paying 12% interest, but you no longer owe $10,000. You only owe this year $8,426. So the portion of your payment this year that is interest is 12% of $8,426, the amount that you still owe this year. And 12% of $8,426 is $1,011.13. Okay, if $1,011 out of the $2,773 payment in year 2 is interest, then the remainder of the payment, that is $2,773 minus $1,011, or $1,762.80, that must be the amount of your annual payment that will pay down the debt or the principal this year. Well, if you began this year owing $8,426, and if the portion of your annual payment that will go towards paying down that balance is $1,762, then the amount that you owe at the end of year 2 is $8,426 minus $1,762. The amount that you owe at the end of year 2, the ending balance of the debt, is $6,663. And you just keep that process rolling through year 3, through year 4, and through year 5. If you do that arithmetic on your own, you will notice that by the end of year 5, the ending balance on the debt will decline to 0, which makes perfect sense because this was only a 5-year loan to begin with. At the end of the 5th year, you no longer owe any money. There are a couple more things that I'd like you to notice. Number 1, in the early years, this is most obvious in year 1, the portion of your payment that is interest is very large. And then as the years go on, the portion of your payment that is interest gets smaller. Well, that makes sense because in the early years, you still owe a lot of money. And so you're paying a lot of interest. In the later years, the amount that you owe is less because you're paying down the debt. And so you have less interest to worry about. And so if you're paying the same amount of money each year, and if you have less interest to worry about, you can put more of your annual payment towards paying off the original principal. And you can see those trends play out on these 5 rows. The other thing I'd like to show you is that if you look carefully at the payment column, the textbook, using that rounding difference argument, increased the fifth and final year payment by about $1. Actually, by precisely $1.06. That is a rounding difference. But had you not paid that dollar, had you not made that tiny, tiny additional payment for rounding differences at the end of at the end of year 5, then you would have had an ending balance due at the end of year 5 of about $1. Most of the time, when you look at these schedules, you do see that tiny dollar still owed at the end of the final year. And at that point, honestly, the lender, the bank, or the other financial institution usually says the dollar is on us. And so you usually don't wind up actually paying the dollar, although in this example, it seems that you do. Okay, that is our walk through the most common statistical data matrix or table that you will find in this chapter. You see this kind of, it's called a debt amortization schedule everywhere, and it is designed to help you keep track of how much principal you really do owe at the beginning and at the end of each period. Okay, that concludes our review of the table in chapter 13. Now, I'd like to ask you to look at, let's see, it's one of those your turn highlighted problems again. And this particular one is figure 14.7. Up to now, we've been going under the assumption that when it comes to the value accounts or equity value or worth accounts of our record-keeping system, that if value increases, not because we've worked to earn it, but because an investor gave us money, we've assumed that we put that value, that we classify it in an account called common stock. We've also assumed that if we create value by working to earn it, that increases in value go into an account called revenue, decreases go into an account called expense, and that revenues and expenses through the closing process that get closed into a line on your balance sheet called retained earnings. Well, 14.7 here shows you a piece of a balance sheet. It's the equity value section, and you see a number for common stock, a number for retained earnings, but wait a minute, there are 3 other numbers here. Why do we need them? Well, let's walk through them conceptually. Let me give you a brief anecdotal, very practitioner-oriented set of explanations. Number 1, there is a line called preferred stock. Now, up to now, we've only had common stock as a line in the value section of your balance sheet. Why might we have other value from preferred stockholders called preferred stock? Well, for the simple reason that you might have more than one set of owners or stockholders, and some might have the right to receive dividends, or actually might have some other preferential treatment that makes them a higher level of stockholder than the common ones. And so we call value that we've received from that premium level of owner preferred stock as opposed to common. Number 2, there is another line called additional paid-in capital. Why do we need that? Well, look carefully at the common stock line and, for that matter, the preferred stock line. The money that we received from our shareholders on each of those lines is about $1,200,000 from common stockholders and $1 million from our preferred or premium stockholders. Those numbers are based on a statistic or metric called par, P-A-R, value. What is par value? Well, basically, when a company registers with the government to issue stock, the company needs to officially tell the government, this is how much I think the stock is worth for bookkeeping purposes. And in this case, the company declared to the government that the bookkeeping or par value of its common stock is worth $1 per share, and the value of the preferred stock, $100 per share. You could see why the preferred stock is premium. But what happens if you register these par values and then you go to sell the stock to new shareholders and they're willing to pay you a lot more than the par value for the shares? Do you accept a lot more money from them? Absolutely. Take the money. If the common shareholders, for instance, want to give you a lot more than $1 per share, take the money. Take it all. But when you come to record the money that you actually take from your common shareholders, well, cash, an asset, goes up by the total amount of money you receive from those shareholders. Common stock goes up by the par value, the stated value, or the registered value that you received from the shareholders. But what if those shareholders give you more money than par? Or, as we would say, additional payments coming in from those shareholders that are giving you their capital to buy your stock. Well, then you are receiving value from those shareholders that is additional paid-in capital, money above and beyond the registered par value, and you have an additional source of value, which appears separately on the additional paid-in capital line. Finally, there's a line called Treasury Stock, and it's a negative number. Why is it negative? Well, sometimes a company goes into the market and says to its shareholders, I previously sold you stock. I want some back. I'll pay you for it, most likely, but I want some of that stock back. Well, if a company does that, then a company no longer has common stock or preferred stock out there. It has taken it back. If a company takes back stock permanently, then it might take the $1 million in preferred stock value at par, or $1.2 million of common stock value at par, it might reduce those numbers if it is taking back what it has previously issued permanently. However, what if a company says, I am buying back this stock from you temporarily, and I might just turn around and resell it to you again, or resell it to someone else? Well then, instead of reducing the value columns that are already there, you create a new column. And just like an allowance for doubtful accounts is a negative receivable balance, treasury stock here is a negative equity value balance. Hope that you've enjoyed this chapter. Again, it's the last chapter of the next to last module in the class, and I look forward to taking you to the final recording, which will be the next and last module recording of the class.